When the economy is starting to look a little scary, who you gonna call? Dollarama! Count your dollars, folks. This is going to be a good one. From their humble beginnings back in 1992 as a single store in Quebec, Dollarama has rapidly expanded to become one of Canada's leading dollar store chains. They went public in 2009 at a share price of $3.38, and nowadays, well, that's exploded all the way up to $94. That is a pretty good track record if you ask me. There is no secret to Dollarama's success as they cater to the more frugal consumer, and there is never a shortage of people who prefer to keep more of their money. In fact, as the economy gets worse, Dollarama's popularity kind of gets better. They fall into what I like to call a recession-proof basket of stocks. But you know, they may just be taking it one step further. This is not just a recession-proof stock, but it can be more like a recession buster. Dollarama is a stock that can make you money while many others around you flounder. Of course, it is nice to get a good sale on some of those other stocks. Unfortunately, Dollarama may be making you money, but a stock like this can also be a hard one to get on sale. In fact, this is a stock that the best strategy may simply be to dollar cost average and then sit back and watch that money grow. Join the conversation. Let us know in the comments if you are invested in Dollarama. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. We last looked at Dollarama back in August of 2022, so it is about time we dive in again. They had a recent earnings report that set the stock on fire, so I have some pretty high expectations for this one. Even with all the window dressings in the world, we are still going to need to dig into those fundamentals. So let's gaze into that mirror and say his name 3 times to summon our good old buddy, Mr. Math. We will start with some good old surface data. They have a market cap of $26.57 billion and, as you expect for a pretty stable recession-proof company, a really nice looking beta of 0.73. Their earnings per share come in at 3.09, and they have a price to earnings ratio of 29.60. Now the average in their sector is actually a lot lower at 14.9, so they are a little high compared to their peers. To give you an idea of that range, we have Canadian Tire with a PE of 9.6, going all the way up to Pan Pacific at 27.1. Keep in mind, Dollarama is still in their expansionary phase, and that will absolutely inflate a PE ratio. Their price to book ratio, that comes in really high too at 129, while the average is, 2.8. This is a big number. And when you factor in some of the recession-fueled growth this company has been experiencing, the numbers are absolutely getting inflated. Speaking of a crazy inflated number, we have the return on equity coming in at 1,554.26%. Holy banana bread, that's insane. This surface data is very interesting to say the least. I can't wait to get into the cash. They have a revenue of $5.51 billion. Their earnings come in at $888.52 million. Now those earnings, they are projected to grow by 10.52% per year. That's not too shabby. In fact, just to put that into perspective, in the last 5 years, they grew at a rate of 10.2%. So if anything, they're still picking up steam. Their free cash flow, that comes in at $1.07 billion, and they have an operating cash flow of $1.25 billion. Let's get an idea on their value. Their current value for the calculation came in at $92.94, and of course, using a discounted cash flow model, we get a fair value of $79.92. That means they're overvalued by 16.3%. Sometimes I am cautious with an overvalued company, but this one may be an exception. The growth that is skewing their numbers up is not about to go away, so this is a valuation that I think I will take with, a grain of salt. The company is making a lot of money. Let's dive a little deeper and see how the returns are actually looking for us. When we look at their dividend, they have a yield of 0.305%. That is very low, and it is paid out quarterly in the amount of 7.1 cents per share. Their payout ratio is also pretty low, 8.16, very sustainable. When we look at return on investment, on the 3-year, their price rose from $51.10 to $93.88. That is a return on investment of 83.72%. Add those dividends in, we get a total return of 85%. When we look at their 1 year, the price rose from $81.43 to $93.88. That is a return on investment of 15.29%, factoring in those dividends, and we do get a total return of 15.60%. Switching to 2023, their price rose from $79.39 all the way up to $93.88. That's a return on investment of 18.25%. Adding the dividends, we get a total return for 2023 of 18.50%. Just to put that in perspective, the return on the TSX for 2023 is currently negative 1.88%. To say they are just outperforming the market, well, that is a huge understatement. So far, this is looking fantastic, but can their debt situation pour some rain on that parade? They have a total debt of $2.26 billion, and their total equity, that only comes in at $203.59 million. This gives us a debt-to-equity ratio of 1,109.9%. This has to be, hands down, one of the highest debt-to-equity ratios that I have ever seen. This number does not sit well with me. However, 5 years ago, this was a negative shareholder equity situation for this company, so they have actually improved. But that debt, yikes, just yikes. They do have some cash and cash equivalents of $252.48 million. Let's look at the short term. On the short term, they have assets of $1.23 billion and they've got liabilities of $1.12 billion. So their short term is actually not looking that bad. On the long term, they have assets of $3.77 billion, liabilities coming in at $3.67 billion. Long term is not that bad either. And I do realize their expansion is not only helping to their success, but it is adding a lot of debt at the same time. I do not like to see that much debt in a rising rate environment. On the plus side, they do have debt coverage with their operating cash flow, and the interest is easily covered by their earnings before interest and taxes, or that good old EBIT. Dollarama will more than likely improve their debt once they finish their expansion push. So what, of course, is the final verdict? Dollarama is going to thrive for a very long time, and if we do move into a recession, it will only make them even more profitable. This is a recession buster company, despite what their debt looks like. They have the deep pockets, and they could do some serious damage to that debt. However, maybe focusing on expanding in this perfect economic storm may not be such a bad idea, as the profits are there for the taking. For the passive income investor, this is most likely not a stock for you. The dividends are small and will most likely not grow much for a very long time. For a growth and total return investor, this is a stock you may want to take notice of. They are going to continue to grow, and this is a great addition to see some green in your portfolio when everything else is trending to the red. When times get better, the growth will slow down, but even on the other side, people will have less buying power than they used to, and that may keep Dollarama into the green for a very long time. If you are interested in this company, be sure to do a whole heaping helping of due diligence before you even consider dropping some of that hard-earned cash on the table. Keep the learning going. Watch my video on the 0 to 100K TFSA challenge linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.